What's up, you guys? Welcome back to the Average Joe on Money Financial Channel, and in this video we are continuing our conversation about Fidelity Index Funds for the complete beginner. But more specifically, we're talking about two specific indexed mutual funds that are very popular with Fidelity, are really low cost, and perfect for the beginner investor out there looking to grow their retirement nest egg. You guys know I hate BS and long and drawn out videos, so let's go ahead and jump onto my computer screen. Let's do a deep dive on both the Fidelity Total Market Index Fund, FSKAX, and the Fidelity S&P 500 Index Fund, FXAIX. Let's go and do it right now. All right, guys, so we're here on my computer screen. We're on the Fidelity Investments website, and we're deep diving the S&P 500 Index Fund, FXAIX, and the Fidelity Total Market Index Fund, which is FSKAX. So let's talk about a little bit about the ways that these are very similar indexed mutual funds. The truth of the matter is both of these funds are what are known as cap-weighted index funds. And what that means is every single investment in the portfolio is not created equal. Essentially, the biggest investments in the portfolio, the ones that the companies that are the largest in size, you're going to think of behemoths like Apple, Microsoft, Google, Facebook. These companies are going to get a larger share of the pie of the investments, meaning that for every dollar you invest in the index fund, a good portion of that money is going to go to the largest funds and not spread out equally among the investments in the portfolio. That's the nature of a capital weight or capitalization weighted index fund, as opposed to what would be known as an equal weighted index fund. Additionally, even though they are fundamentally different strategies, they're very similar in returns, meaning that the S&P 500, it follows a specific index. It follows the S&P 500 index, meaning the top 500 companies in the United States based on market capitalization and other different rules that require inclusion into the index. It follows those 500 companies. And that's it. The Fidelity Total Market Index Fund is a little bit different here, so we pop over here. This index fund follows all the stocks in the index. Every single stock available to purchase, it purchases. And let me show you that here. If you scroll down here, we will, actually, let me go here. We come over here to summary, and it'll give you a breakdown of how it is invested here. If we go down to fund overview, seeks to provide blah, 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 normally investing at least 80% of its assets in common stocks included in the Dow Jones U.S. Total Stock Market Index, which represents the performance of a broad range of U.S. stocks. So even though it's investing in a different index, you're going to find that these indexes overlap, right? Because the total stock market in the United States and the S&P 500 are both U.S. indexes, and furthermore, because it's a capitalization weighted index fund, there's a lot of overlap, not only in the stocks that are invested in, but also the weighting in the stocks. Let me show you what I mean here. So if we come over to composition on the website, and by the way, you can go into the Fidelity website and do everything I'm doing right now if you want to get your hands on it yourself. Composition for the total market, and then composition for the S&P 500. You're going to see here that you scroll down here, top 10 holdings. So you see here, top 10 holdings for the S&P 500 index fund shows you that the top 10 holdings are Apple, Microsoft, Amazon, Facebook, Google, blah, 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 blah. But those 10 holdings, those top 10 holdings represent 27.86% of the overall index, meaning that even though there are 508 holdings, technically 508 holdings, the top 10 are getting 27, we'll call it 28 cents of every dollar you invest. Some people see this as a good thing, meaning that a good portion of the money is going into companies that are continually performing well. They're at the top of the game. But other people see it as, well, I thought I was buying diversification, but in truth, I'm buying a lot of the top 10 holdings. And you could probably mirror that by buying these 10 individual stocks plus a few others. So there's both sides of that coin. But when we look over here to the Fidelity Total Market Index Fund, we come down to composition. Even though it says here that there are 3,438 holdings, which is a significant amount of different stocks in the portfolio, the top 10 holdings still represent 23.11% of the portfolio. For every dollar, 23 cents is going to these 10, and then the other 3,428 holdings get only 73% or 77%. So you think you get a lot of diversification, but you're getting a lot less than you think you are because it is a capitalization weighted index. Now that doesn't mean that either of these indexes are bad index funds to invest in, because the truth of the matter is we know that over the past 10, 15 years, the amount of growth in the stock market has been driven, yes, by overall stocks, but definitely by these stocks: Apple, Microsoft, Amazon, Facebook, Google. So you want to have your money invested in these companies because this is where you're going to grow. One of the great things about Fidelity Index Funds, I generally have been a Vanguard guy in the past, and I definitely still am when it comes to exchange traded funds, because the offerings there are much more significant than you find at Fidelity. But when it comes to indexed mutual funds, Fidelity's got a lot of options available to the average Joe investor out there. And for example, with both the Fidelity 500 Index Fund and the Total Market Index Fund, you're going to see that the total minimum dollars to invest is $0, meaning that you can start with $5 or $10 or $15. And then additionally, the expense ratio, and this is, by the way, the same for both Fidelity 500, you see the minimum to invest also $0. The expense ratio is significantly lower than competitors out there. There's like the Schwab Index S&P 500 Index Fund, which is 0.02%, and you've got Vanguard, which is at 0.03%. But at 0.015%, this is the lowest fees available for the S&P 500 Index Fund. We also have talked about in previous videos that Fidelity has the 0 expense ratio index funds, and those can be a great option for the beginner investor as well. But just speaking to these two index funds, 0.015% as an ongoing annual expense ratio, meaning that if you were to have, let's say, $10,000 invested in either of these index funds, the total amount of money you would pay as a fee to Fidelity to manage these investments on your behalf, $1.50. That's all. All right, let's talk performance for both of these index funds. The annual returns, the 1, 3, 5, and 10 year, are as of October 31st. The year-to-date return is as of November 2nd. So we've got here 4.04% year-to-date for the Fidelity 500 fund, and that compares over to the total market fund at 4.30%, which is interesting. What we have been seeing as a trend over the past 12 to 18 months is that the Fidelity 500 fund was beating the total market because it had a higher weighting in those top 10 holdings, which were driving a lot of the growth over that time frame. But this is interesting that year to date we're seeing a better performance in the total market fund as opposed to the S&P 500. For the 1 year return, we've got 9.99% for the total market, 9.7% for the 500. For the 3 year return, 10.41 for the 500 return, and for the total market, 9.96. Very, very similar here. And then we've got 11.43 and 12.76 for the total market, and then 11.7 and 13%. So we've got very, very similar returns. And as you can see right here, it kind of gives you a hypothetical growth of $10,000. So FXAIX is the S&P 500. We got $18,115. Actually, hold on, let me pop over here to the total market. This is a better way to do it. So as you can see here, when you compare these two index funds head to head in this chart, you're going to notice that the returns are very similar here. So right here, if you were to start with a hypothetical $10,000 in the total market and the S&P 500 historically, which we can look back on and know, we obviously don't know what the future holds for any index fund or any stock or bond. But you see here, start at 10,000, we come through here, pretty much mirroring each other's returns. And only during the COVID drop here in 2020, or actually a little bit before that, in late 2019, did we start to see just even the smallest amount of separation. But at the end of 21 years, we'll call it 20 years. Here currently, if you invested $10,000 in each of these index mutual funds back in 2011, 2010, you'd have in the total market index fund $35,270, and only at least maybe $1,000 more in the S&P 500 fund at $36,206. So essentially, you're buying a very, very similar indexed mutual fund. The question for yourself is, do you like the extra level of diversification you get with the extra holdings for the total market index fund? I mean, the only other big difference here you can compare between these two index funds is their distribution schedule for their dividends. With an index mutual fund, there are underlying investments, stocks, that pay dividends. And what happens is the indexed mutual fund will then gather those dividends and pay them out on a set schedule depending on what the investment manager or company decides on. And we do see a difference here. We see that with the Fidelity Total Market Index Fund, we see dividends being paid out not on a quarterly basis, which is generally the standard, but you see it on a semi-annual basis, April and December. And you can see those historical returns there for the dividends. But if you pop over here to the S&P 500 Index Fund, you're going to see that it pays it out on a quarterly basis. Now that ultimately hasn't changed much of the returns. You could maybe make a case that quarterly dividends was the reason why the returns were much more significant. I mean, you can make the case that because of the quarterly returns of the dividend compared to the semi-annual for the total market, that's the difference in the overall return, but I doubt that's the case. I think it's the small differences in the holdings and the higher weighting in the top 10 holdings. It ultimately didn't make a difference here. If you're an income-driven investor, well then I wouldn't compare these index mutual funds at all. I wouldn't invest in them. But if we're looking for long-term growth, for the average Joe investor out there, you're not going to go wrong with either of these index funds. You're going to get very similar growth, and you're going to get the type of growth that many people out there are looking for, which is the type of growth you don't have to watch on a daily basis. You don't have to worry about your investments. You don't have to worry about whether or not it's paying their dividend or increasing their dividend. You get solid, sustainable, consistent growth. And who doesn't want that as a beginner or average Joe investor out there looking to increase their retirement nest egg? So hopefully you found some value out of this video, guys. Make sure to leave your 2 cents in the comments below. Do you invest in either of these 2 index mutual funds with Fidelity? If not, where are you invested right now? Are you with a different brokerage and investing in their index mutual funds? Or are you maybe investing in different Fidelity holdings here? Let me know. Leave your 2 cents in the comments below. And that's all I got for you guys. Have a great rest of your day. And please, during this pandemic we're still dealing with, please continue to stay healthy, both physically and financially. Have a good one.